In the fifth monetary policy for FY23, the MPC unanimously decided to hike the policy repo rate by 50 basis points. Given how volatile the debt and equity markets have been, we thought it would be a good idea to discuss what this means for a common investor like you and I. The RBI also decided to focus on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. I have with me Mr. Kshitij Jain, co-founder of CAGRfunds, to discuss this on a regular basis with us. Kshitij, welcome and
Hi,
good morning.
Shruti. Yeah, hi, happy to be here.
So, Kshitij, let's begin by discussing what is a repo rate and what does a hike in repo rate really mean?
Okay. So in the most simple terms, I think repo rate is the rate at which banks borrow funds from RBI. And for borrowing these funds, they have to place a collateral with RBI, which is normally the government securities of India or state governments, right? And so what a hike means is this is basically a liquidity tool for RBI. So what a hike means is that RBI is saying that, okay, I'm going to increase the rates for you to borrow. So your cost of funds are going to go up and you pass to the corporates. And so the corporates cost of funds will also go up. And so they are kind of engineering a slowdown in growth. And the slowdown in growth in turn means reduction in inflation. So that's the idea behind hiking rates. And vice versa, if they are going to cut rates, they are actually trying to give a boost to the economy by reducing the cost of funds for the corporates or consumers in
So
general.
basically, a hike in rate would mean that potentially banks would borrow a little lesser from RBI and therefore lesser money would be available in the economy and therefore lesser liquidity, right?
So yeah, so liquidity is one part of it. Hike in rates actually means that their cost of funds have increased. So either they because in all sense this will be the cheapest cost of funds available for most of the banks, apart from savings, right? In the sense there are few big large national and private banks which have savings deposits with them, which may be lower cost than this, but otherwise this kind of becomes the floor for cost of funds for most of the banks. And obviously, if you are going to give a costlier fund, and then the obviously liquidity in market also gets dried up. So yeah, so so
All right.
so by the side of so RBI is doing both the things. They are reducing in liquidity in market by slowly, which they pumped up during COVID, and also hiking rates. So on both measures they are working.
So why is RBI really hiking rates now?
So RBI is hiking rates largely because inflation has become a problem. We have seen almost this is almost the eighth straight month where inflation has come in above the RBI comfort level of 6%. So in August, the inflation was 7%, which is the retail inflation I'm talking about. The WPI inflation numbers have actually just skyrocketed even earlier. So they've been in the range of 13-14% for a long time. So that number, so yeah, but the main concern is retail inflation. That is the policy target, which the RBI targets at 4% with the plus minus 2% range, flexible range that is the target. So that is the main concern. In addition to that, there has been two major shocks which is actually a concern for RBI, which is the Ukraine crisis and plus the sharp increase in rates across the world, right? The central banks are hiking rates uh, considerably, and which kind of makes uh, the rates in India, which may play a role by putting pressure on RBI to also hike rates, so that we our interest rates differential with other countries don't go haywire. So because that will impact the currency. So that's
Right.
broadly the idea.
So we have also been reading so much about, inflation being higher than normal even in the US. So clearly India is not alone in this. Could you throw some light on what other central banks are also doing in this space?
Right. So other central banks So obviously we are not alone. This is, I think, the big concern for most of the other central banks. So Fed for this week itself, I am telling you, the Fed has hiked rate by 0.75%, which is almost the third jumbo rate hike. And Bank of England has risen rates by seventh straight hike this week. Uh, Similarly, Swiss National Bank has risen by 0.5%, which has actually taken their rates out of negative territory after 2015, first time out of negative territory. Norwegian central bank has hiked rates, almost a decadal high for them now. So this is a all pervasive kind of problem. But having said that, the advanced economies are much more affected by inflation than the developed economies in general. And India in particular, we have seen these rates are not something which you have not seen in recent times. So 7% inflation is not something unforeseen for even this generation, right? In the sense
Yeah.
we have seen these rates in the last decade. So, but for most of the advanced economies, the rates have actually been higher than I think maybe 15, 20 years. So that is a big concern.
Right, right. That's true. So rate hikes are happening all across. But how does it really impact, like a common man investor or a saver like us? What does it really mean for an investor? How do they really gauge the impact of these rate hikes?
Right. So for an investor, or let's say a saver, right? In the sense, we will just focus on the saver first, and then we'll talk about investor later on. So for an investor, for a saver, the hikes are actually good in that sense because you're saving money, you're putting your money in deposits, and the bank deposit rates are bound to go up. Though banks are normally slow in hiking deposit rates when the RBI hikes rates, but it will eventually happen because as we said, the cost of funds are rising for banks. So they want to garner more deposits. So they have to hike rates, and SBI, PNB, they have also hiked rates. Some of their rates have gone up in upwards of 6%. They were earlier around 4 to 5% range. So there has been considerable hike. RBI on its part has hiked around 140 basis points in this cycle. And so banks are also following up, around 100 basis point or so has been passed. So for a saver, the era of low interest rates is actually gone now, at least for the near future. We should see a positive or a higher rate for savers. Though having said that, above inflation is the rates are still not there. So if we say inflation is 7%, the deposit rates are still below that. But yeah, even considering that, the rates are going to rise, and it's a good time for a saver, at least for senior
Good
citizens or
news.
savers.
Absolutely.
Yeah,
Right. So absolutely. For
right.
senior citizens, I know for a fact that a lot of banks have increased rates very close to 7. So at least for the senior citizens, they can manage with FDs, just matching inflation. But what about people, I'm talking about two kinds of investors here. One who have already invested in debt funds. What does this mean for
Mhm.
them? And second, for people who are thinking about investing in debt funds. So what does this mean
Okay.
for debt mutual fund kind of investors?
So so any debt mutual fund or any debt product per se will lose value when the interest rates go up, right? Because you have if it's a fixed rate product, most of the bonds in the market are fixed rate largely. So if it's fixed rate product, if the market rates have risen and you are getting a lower rate, so you're going to pay less for it. So the rate the so the any rate hike is negative for debt mutual funds for the existing investors. But the impact of negative is different for various tenors, right? For various durations. So the smaller the duration, the less the impact. We will have the lowest impact for overnight funds, right? They will have the lowest impact because you are holding uh, securities which are maturing overnight, right? So you get your hike exactly the next day, right? So even maybe you lose interest for one day. That's the only thing. While as we go up, and the impact would be the highest in a long duration fund, right? Uh, so what we recommend to our clients, or what we are thinking is best for normal investors in mutual funds, is that you small duration funds have will low duration funds per se will become attractive, because now we have seen around 4, even lower than that, rates in low duration funds for some time in the last few years. But now, if the repo rate is at 5.90, the low duration fund should give close to that, right? In the sense, close to that, or even maybe 10-15 basis points higher. So low duration fund is a positive thing. And plus the tax efficiency that debt mutual funds bring in, if you are able to hold them for a longer period, more than 3 years. So that also plays a part. Secondly, if you are a long-term investor and you're looking to lock in, you want to lock in rates, right? Higher rates, because we are seeing a era of higher rates, and you want to lock in, and don't want and you prefer that you have some sense of what rate you are going to get at your investment. Then target maturity funds are also preferred option. These are basically passive debt funds, so that the costs are also low for investors, and you get a considerable, I would say, a relatively fixed interest rate if you are able to hold them to maturity. So the YTM,
Right.
which the bond is showing, you should be able to get that. Yeah.
So to quickly summarize, if there's somebody who's looking for parking money for liquidity or for a very short time duration, they can actually use low duration funds. And for people who are looking for a slightly longer tenor debt investments, then probably target maturity funds look like a good alternative to them. Right. So how does, so we've spoken about investors, Kshitij. How does all of this rate hike impact people who have taken loans? Because on one side, while it does impact savings and investments, on the other hand, it does really impact the lending part on the banking balance sheet as well. So how would a borrower get impacted here?
So yeah, for people like us who have home loan EMIs, the EMIs are bound to increase, or if the EMI remains same, the tenor of the loan is bound to increase. So every percent hike on a 50 lakh loan for 20 years leads to almost 7 lakh of cost to the borrower over a 20-year period. So it's not a small impact. You end up paying 7 lakh more. These are going to impact. So we've got around 1.4% of hike from the COVID lows. So the loans rates have become costlier. So you need to keep watch of that, and probably some part of your surplus income will go in serving EMIs now. So that is a big impact. And for otherwise also, the retail loan costs are going to increase. So personal loans, or your whatever, so loans for where you get your electronic items and all, or vehicle loans, all are going to rise. And so that will impact the consumer more. So if you are looking to take a car loan or a personal loan, the rates are going to be high.